Here are my top 10 stocks to buy right now that I am currently investing in my portfolio. These stocks are collectively up 35% from their lowest price earlier this year, which is pretty par for the course with the huge swings we've seen in the stock market over the past couple years. But let's not waste any time and let's dive into my actual Charles Schwab portfolio to see the stocks that I'm currently investing in that I believe have the best chance of making very positive returns going forward. So if we look at this portfolio year to date, we can see my portfolio is up around 23% and it's up around 35% from this low on January 6th. But if we zoom out a little bit more, we can see it's been a little more rocky over the past year. Last year, my portfolio had a huge drop at the beginning of the year before recovering slightly, dropping again, and then recovering again. This is kind of just par for the course when you're investing in high volatility growth stocks and especially technology stocks. But if we were to zoom this out even farther to a 5 to 10 year time horizon, we would see that this portfolio has actually outperformed the market over that time. But with that said, let's just go ahead and dive into the first stock position. So the first stock we're going to talk about today is Datadog, which I currently own 330 shares of at a value of just over $25,000, and that's actually down off an initial cost basis of $32,000. So it's lost around $5,000 overall. Now, Charles Schwab gives this stock a D rating, but that doesn't actually have to do with the stock's performance. That's more of a valuation metric that Charles Schwab gives. I've had other stocks like Crowdstrike, which ended up making me something like a 300% return, yet Charles Schwab weighted it as an F the entire time that I owned it. Just because it wasn't a value stock, it was more of a growth stock. So I wouldn't put too much confidence into their ratings. Now, Datadog is a data company. They unite a company's applications, their infrastructure, and their security all through a single pane of glass. To basically simplify, as more and more companies generate more and more data, they need to be able to extract insights from that data for it to be valuable. And if that data is spread across their whole organization, that's really difficult. Datadog makes this super easy to do, and it's clear from their very high revenue growth rate that their customers love it. In their most recent quarter, the company beat earnings expectations by growing 61% year over year in terms of their revenue, while having an extremely high adjusted gross margin and being free cash flow positive. Now, if you use GAAP accounting, they're going to show up as unprofitable because a lot of their money goes to R&D and paying expensive engineers and stock-based compensation. But as we enter a recession, cash is going to be king, and this company is throwing off a ton of cash. Hey, by the way, welcome to FinTech. If you find anything valuable in this video, maybe just leave a comment or even subscribe. There's not going to be any sponsor or anything, so that's my only ask for the video. Next up, we have Snowflake, which I currently own 160 shares of at a value of $25,000, and that is also down a bit off the initial investment of just under $30,000. And again, that's just Snowflake being a victim of the recent tech and growth stock sell-off. Now, Snowflake is also following the general trend of data. If we think back to the early days of data, everything was handwritten on pieces of paper, stone tablets. Then we moved on into simple computers where things were stored in Excel spreadsheets and databases. Then we got data warehouses, then we got the cloud, and now we have the next magnitude leap forward, the data cloud. Snowflake basically manages other companies' data for them, allowing them to focus on the things that actually make them money. They allow them to do things like set up access to their data, share their data with other companies so they can all collaborate, and even build new tools and applications on top of their existing data. This is a capability that would be extremely expensive for a company to build on their own, and that's why so many large companies are moving to start relying on Snowflake to handle their data. Now, Snowflake has always been an extremely expensive company ever since they first IPO'd. They're currently making just over $500 million in revenue per year, but their market cap is nearly $50 billion. This assumes that Snowflake is going to maintain a very high growth rate going forward like they have in the past. We can see that they're currently growing at 66% year over year, and if we look back at their previous quarters, they grew 82%, 84%, over 100%, and this high growth rate is the reason they are so expensive. Now, currently the company is not yet profitable, but as they scale and get more and more customers, they're becoming more and more efficient with their money, meaning that profitability gets closer and closer. We can see that their net profit margin increased every single quarter for the last few quarters and is getting closer and closer to them breaking even. At the same time, the company is free cash flow positive, meaning that the actual business is throwing off cash that they can use to spend on other things. This is important if we enter a recession because they can use it to buy back stock at cheaper prices, acquire new companies that might compete with them, or just launch and build new products that are going to benefit their customers. Snowflake is positioned extremely well to capture way more market share in the future, and because they're also benefiting from just the general growth of the cloud and data, this is a very high conviction position for me. And if you think this company is just a high growth stock that has no chance of ever making money, you can look at a really famous value investor like, I don't know, Warren Buffett, who I think is the greatest investor in the world, and his company, Berkshire Hathaway, is investing in Snowflake. Now, that's not a reason to invest in it on its own, but it is a good indication that maybe this company isn't as overvalued as some people think. And by the way, stick around until the end of the video to see what new stocks I've purchased in the past month. Number 3 on my list, we have Cloudflare, which I currently own 317 shares of at a value of $21,000, and this one is up a little bit from the initial cost basis of $20,000. Now, this isn't actually accurate because I sold some of my Cloudflare and then bought more of it at a higher price, so because of the way Charles Schwab calculates the returns, this is actually a little bit less than it would actually be. Now, Cloudflare, like Snowflake, is benefiting from the shift to the cloud. They are trying to make the internet itself work better. They started out by just trying to host websites on their servers, and then they moved into firewall to actually protect those websites. Then they realized if they're already hosting the websites and analyzing all this traffic coming in and out, they could also optimize the web experience for the good actors who they want to access those sites, not just block the bad actors. Since then, Cloudflare's product portfolio has absolutely exploded, where they've moved into basically all aspects of the cloud, including security, analytics, performance, and reliability. At this point, Cloudflare is actually starting to compete with the big web cloud providers like AWS, Azure, and Google Cloud, something that would have been unheard of a few years ago. On top of that, Cloudflare plans to become profitable later this year, and they say that they will 5x in size over the next 5 years. And this is a company that always beats their earnings expectations, so I have a very high confidence that they will achieve those goals. Number 4, we have SoFi, which I currently own 1,900 shares of at a value of $13,000, and that's up off my initial investment of $12,000 overall. Now, I poured a bunch more money into SoFi a few months ago when I saw that they were trading at around $5 per share, which at that price would actually put them below their book value, meaning SoFi would be worth more if they broke it off and sold it off for pieces than it would be existing as a full company operating together, which meant that as an investor, in order to make money in SoFi, all I had to do was show that SoFi had any value whatsoever put together as a company, as opposed to being broken up and sold off for parts. And that value becomes extremely clear when you look at their business model. SoFi is basically 3 businesses in one. You have sort of their top of sales funnel, which is their financial services. That includes things like the SoFi app and the SoFi credit card, where they get new customers. They then funnel them down into more valuable areas of the company, like their lending business, where they make most of their profit. And underpinning all of this is their technology platform, the technology backbone that supports their business, as well as competitors such as Robinhood's app. Even at their current price of just over $6 billion for the company, this still feels extremely undervalued for me, considering the company is starting to become profitable and they're growing at around 50% per year in terms of their revenue. Now, 50% might not sound like a lot until you plug it into a compound interest calculator and see just how dramatic that effect can be. If we assume you have the company worth $6.2 billion today, and over 5 years they grow at 50% per year. Well, if we assume that their market cap moves in lockstep with their revenue, which it rarely does, but if we make that assumption, that would mean that in 5 years, SoFi would be worth $47 billion, a 7x increase in price from where they are today. Now again, this is just back of the napkin math, and it's not likely representative of what SoFi's value will actually be, but it does show that it's very easy for SoFi to be undervalued at its current price. All they need to do is keep on growing without doing anything that would horrendously affect the company going forward. Now, you may notice that a lot of these stocks have things in common. They all tend to be in tech, but there are actually several macro trends that I am actively investing in, which I believe are going to make a lot of money for certain investors. The 4 main trends that I'm focusing on right now are data, the cloud, security, and fintech companies. And I believe that investing in these trends as they continue to grow basically is like a cheat code, where these companies already have built-in growth for the future. Then if we can pick the best companies in each of these trends, we can see outsized returns. So with that said, the next 2 companies on this list are both in the security space. We have ZScaler and Sentinel One. So with ZScaler, I currently own 82 shares of the company at a value of $10,000, and this one is actually down quite a bit. It's down from the original almost $20,000 I had invested in it. And that's because this is a stock that I bought kind of around the peak of the tech market around a year ago. Now, ZScaler offers zero trust security, something that is essential as more companies move to the cloud. If you think of a traditional security model, you have your campus of buildings and you have a firewall around the network of that campus. So the bad guys can't get in and the good guys can all talk to each other inside. What happens if a bad guy does get in? Well, they basically have free reign to access your entire network. And when you're operating in the cloud where everything is connected, that's not acceptable. Zscaler offers zero trust security, so every person, every computer, every application has to authenticate before they talk to anybody else. This is the security paradigm that all companies are going to move to eventually, and Zscaler is the best positioned company to take advantage of this trend over the next few years. But while that sounds like a great story, the only way we know that's true is by looking at their actual numbers. In their most recent quarter, Zscaler grew their revenue by 50% year over year. And if we look back over their last few quarters, that's not even the fastest that they've grown. Now, you might say that this is just an unprofitable company that's never going to be making money, and this is like investing in the dot-com bubble of 1999. The issue is a lot of the dot-com stocks back in the early 2000s literally were just vaporware. They were just selling an idea. These are companies that have customers customers that love their products, that are growing extremely quickly, and that are becoming more and more profitable every year. While yes, they may be burning money in the short term in order to capture market share, once they own that market share and they are locked in with their customers, they can basically print money going forward. This is similar to the strategy used by Amazon, who was unprofitable for 2 decades before suddenly emerging as one of the most profitable companies in the world and making Jeff Bezos the richest man in the world. Next up, we have Sentinel One, which I own 582 shares of at a value of $9,000, and this one is down around 50% from the nearly $18,000 that I invested in it. This is kind of the same story as ZScaler, where I invested right at the peak, and so it's just kind of ridden the general market down over that time, but I still have a lot of faith in this company. Sentinel One is like a super advanced antivirus. They use AI to analyze all the different attacks that are happening on different companies and then use that to proactively prevent future cyber attacks. In a world where more and more companies are continuing to transform into digital companies, cybersecurity is becoming more and more important every year. Now, in the short term, we may see a slight slowdown in security spending if we enter a recession, but over a longer time horizon, say 5 to 10 years, this is going to be one of the fastest growing areas of the entire stock market. And Sentinel One is one of the fastest growing companies within that market. If we look at their revenue, they grew their revenue over 100% in their previous quarter. At the same time, they have a dollar-based net retention rate of 134%, meaning every dollar a customer spends this year, they can expect that same customer to spend $1.34 next year. That's a sign that as customers start to use their product, they see more and more value from it over time. On top of that, Sentinel One is one of the lower valued companies in this list. They're currently valued at under a $5 billion market cap, which is around 4 times their current cash position that they're sitting on. I think the reason they are lower valued though is because they're not currently free cash flow positive, which if we do enter a recession is a negative hit against this company, since it doesn't give them quite the same flexibility as companies that are throwing off a ton of cash flow. I think this is a great company with a ton of potential, but that's why this is one of my smaller positions overall. Next up, we have Bill.com, which I currently own 74 shares of at a value of $6,900, and that's off an initial investment of $12,000. Now, Bill.com is a little unique out of all the companies on this list. While a lot of these companies are these cool, techie, hyper-growth stocks, Bill.com is kind of a boring company. They offer basically back-end automation for small and medium-sized businesses. Most of the customers that they're taking on currently keep track of their businesses on handwritten pieces of paper or using Excel spreadsheets. And so it's not hard for Bill.com to onboard those customers and show them a huge amount of value over their previous processes. This is what's known as a greenfield space, where there's no real competition yet, and Bill.com is able to grow as fast as they want. And this is why, if we look at the company's revenue a year ago, they were growing at 190% year over year, then 180%, 156%, and then 94% in their most recent quarter. Now, those numbers are going to come down as they grow and they have a bigger base of revenue that they need to grow off of, but that's still an insanely high growth rate, and since they don't have any immediate competition taking away their customers, Bill.com is positioned extremely well to just continue growing into the growing market of small and medium businesses. They're also starting to take advantage of all the data that their customers generate, including who their customers are paying money to, so that they can expand their network of potential customers. Basically, if you have one customer who communicates with 10 different vendors, well, all 10 of those vendors are now a new potential customer for Bill.com. Next up, and not yet showing on this list because I just bought it this morning, is Crowdstrike, which I currently own 55 shares of at a value of around $6,000, and that hasn't moved because I just bought it a few hours ago. Now, Crowdstrike is very similar to Sentinel One in that they are a cybersecurity company that's using AI to protect companies. Some of you may remember the SolarWinds hack that happened a few years ago, which impacted companies ranging from Microsoft to Ford to Visa to MasterCard to AT&T. And guess who's the company that first identified that hack and was able to mitigate it for their customers? Crowdstrike. If you remember a few years before that, back in 2014, there was another hack by North Korea called the Cozy Bear attack, which hit groups like the Democratic National Committee. Who was there during that breach as well? Crowdstrike. Crowdstrike is currently the leader in the cybersecurity space for the cloud. And as more and more companies are moving into the cloud, especially large companies, Crowdstrike is their first choice. Crowdstrike's also throwing off massive free cash flow, which can allow them to potentially acquire competitors if there's a downturn in the market. This is a company I used to own a few months ago, and then I sold out, and then I kind of bought back in, just because the company's growth rate isn't as high as it has been in the past, and I tend to invest in more growth-focused companies. That being said, the company is still growing at a solid 50% year over year, and that's that's off of revenue of more than $2 billion per year. So this is a much larger company that's still growing at 50% year over year, which, remember, if they could maintain that growth rate, would mean the company would more than 7x in size over the next 5 years. So that covers the first 8 individual stocks that I own in my portfolio, but there's still 2 more stocks to go over. Next up, we have VFFXS, which is a Vanguard index fund that tracks the S&P 500. We also have VMCPX, which is a mid-cap offering from Vanguard that just tracks mid-cap stocks across the market. And then I'll throw in one other bonus stock, which is VTSNXS, which is a Vanguard index fund that tracks international stocks. Now, I don't only invest in individual stocks. I actually put over 15% of my income directly into index funds like the ones I just listed. This makes sure that I will have enough money in retirement by investing in these much more stable stocks, and then it lets me take the rest of my money and deploy them into much more aggressive strategies like my individual stock portfolio. This gives me a higher risk, but it also potentially gives me a much higher return. Because I'm diversified into index funds and also real estate, I own the home that I'm currently filming in. That allows me to aggressively invest in individual stocks and psychologically feel safe doing so, because I know that if I lost all this money, I would still be okay, which ironically allows me to make more money in the stock market because I can be more aggressive. Now, I told you that I would also let you know any trades that I made in the past month, so the only stock that I bought were those 55 shares in Crowdstrike. And sorry about the lack of videos over the past few months. I've been working on something which I think is going to be extremely exciting, but I'm going to announce it a few months from now. So make sure you're subscribed so you can see that, and maybe share this video with a friend if you found something valuable. And here's another video you might want to check out that you might enjoy.